Welcome to NREI's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at NREIonline.com. Let's jump right into this week's podcast.
Hello and welcome to another NREI's Common Area Podcast with David Bodamer. All right, David, let's start talking about these top stories, and what do you have for us today?
So we got a couple of highlights to go through from the week. I wanted to talk about a recent piece of exclusive research, the latest piece in our research series that's looking at some trends among the brokerage firms. Then we got a couple other pieces about investment, one about a trend of what foreign investors are doing in the multifamily sector, a piece about how industrial investors are, how they're changing a little bit geographically where they're spending their money right now, and then finish up with a piece on an interesting trend in the self-storage sector.
All right, well, let's go ahead and start talking about the exclusive research. This seems pretty cool that you guys are doing this, right?
Yeah, so it's part of we have this, we call it the NREI research series, and we do about one or two of these every month, and some of the previous episodes kind of are fully dedicated to entire pieces of research. For this one, I thought it was probably best just to give the listener some highlights and just kind of direct people to go to the site to read the full thing. But this is one about this one's a little different than some of our other ones. A lot of our other ones look at specific property sectors and then what our readers expect in terms of what's going to happen with fundamentals, our occupancy rates going up or down, or our investment sales levels going up or down for each of the property types. This one's a little different, where we actually, and we don't do this one, we haven't done this one every year historically, but this one is about what's happening with the brokerage firms themselves, especially in light of that, in the last decade, at least, there's been a bit of a realignment. There's been some of the bigger firms. There's been a lot of combination, big mergers, a handful of really big firms kind of dominating at the high end, and then the emergence of some smaller boutique firms in the wake of that consolidation. So this was a chance. We use this as a chance to kind of check in with. So the survey goes to our readers, and we ask both people that work at the brokerage firms themselves, as well as subset some of the questions to people that work with their clients, basically people that work with the brokerage firms, to get some of their sentiments about the sector. So that's kind of what the study is.
Okay, and so from that, what came out of the study?
So we found that in terms of the mergers that have happened, that we asked a couple of questions. One takeaway is that the majority of respondents think that we might see more mergers coming ahead in the future. That some of the bigger entities in the space may not be done, and I think that was something like 3/4 of respondents said they expect further consolidation. So that's one takeaway. And then another question we had about mergers was, what are some of the biggest challenges when those happen? And we found that overall, that merging corporate cultures was identified as the biggest challenge when these kind of big corporate broker combinations are taking place. After that, a couple other tough concerns were, and for merging corporate cultures, that was something along the lines of 2/3 of respondents pointed to that as being a challenge. After that, other challenges that got a fair amount of response, but more like in the 30% range, were things like employee retention, merging of systems, and getting buy-in from employees when these things are happening.
Were there any sort of calls to action, or any things that your listeners really need to take away and say, oh my gosh, I can use this research for?
I think in terms of that particular question on the mergers, I think it just underscores that the challenge, that when you're doing these things, it's not something to be undertaken lightly, and that just because there might be synergies on the surface, the actual brass tacks of putting these things together does seems like it's created some problems, or
Gotcha.
not problems necessarily, but challenges.
Okay. What else? You said that this not only talked about what you normally talk about, but also like big picture stuff with investors across the board, right?
With in terms of like, we asked what kind, like, so on that front, what we did was we asked what kinds of firms and the investors or even companies that are leasing space, which kind of brokerage firms they prefer to work for or work with in the industry. So we found that generally they actually have a slight preference for working with the boutique firms, even though a good chunk of them also still, I think for the most part, let me just rephrase that a little bit. So for the most part, they are working with the full service real estate companies, but they have a slight preference to work with. I think they get a better experience. It seems like they get a better experience when they're working with boutique or independent firms. So I think something like they said in about half of the time, the kind of when they're working on, I guess they're working on investment sales deals or working on leasing deals, they're working with the big boys. But in terms of like the preference of who they like working with, they gave the boutique firms a slightly higher score, if that all makes sense.
It does. It totally makes sense. Now let's talk about what the industry is doing in terms of being more diverse in recruiting next gen sort of talent.
Yeah, so this was a new question that we added to this year's edition. And I probably should mention the last time we did this survey was 2015.
Okay.
So for if people go to the story, a lot of some of the questions at least are compared to the 2015 results. This was a new question that we wanted to ask, which is we basically asked how good a job are brokerage firms doing, both increasing diversity and in recruiting that next generation of talent to the industry, and found that generally, like on both fronts, people gave the industry kind of a fair score. Like people were allowed to give it a score from 1 to 5 on like how 5 being excellent, 1 being poor, and the bulk of responses were 3. So people think I guess not it's not abysmal, but clearly people don't think the industry is doing an excellent job of either recruiting a more diverse base of people into the industry, or in terms of like how they're getting younger people into the industry. So the one last takeaway is we asked what are the most important qualities to clients when they're working with brokers, and generally found that the highest scoring, the most important things are both the quality of deals that brokers are bringing to them and a surety in actually closing those deals. So those are by far the 2 most important factors for clients. Then other things that were important but of less importance were things like just general familiarity and relationships that they may have with a broker, access to certain markets, the broker's track record, and then least important was just access to a broader array of services from the brokerage firm. So I thought that was kind of interesting, especially since a big push in the industry has been about becoming full service, one-stop shops, providing a whole menu of services to clients. At the end of the day, it seems like clients, they don't dismiss. It's not like they dismiss it. They like that. They give it a good. They still gave it a good score. But at the bottom line is what's most important to them is quality of deals that you're bringing to them.
Okay. Now, foreign investors, the next story, foreign investors ramp up multifamily acquisitions. What do we have there?
Yeah, so this was, just a quick, this is based on some recent data from both companies like Real Capital Analytics and the brokerage firms like CBRE. What jumped out, I think what's important about this observation is that this comes within the context of overall in 2019, we've had an environment in which foreign investment in commercial real estate more broadly has declined. But in spite of that, in spite of there being less cross-border investment in U.S. commercial real estate, when you look specifically at the multifamily sector, volume has been up. So it's kind of a counter trend to the bigger trend that we've been seeing this year.
Now, when it comes to some hardcore numbers here, your article here really breaks down some of the larger deals and some percentages and some overall averages for some prices. Do you want to go into that a little bit?
Yeah. So overall, what the numbers from RCA said is that cross-border investors have spent $16 billion in U.S. apartment property acquisitions in over the past 12 months, ending in the second quarter, and that's a 10% increase year over year. And then, more interestingly, when you look at the kind of deals they're doing, is they tend to do bigger deals. So it's the average deal price is about $43 million. That's twice as much as the broader industry average. And they also paid an average of $200,000 per apartment unit at an average cap rate of 5.3%. Those are also higher than the general averages for investments in multifamily property overall. So what I think that means, and it's not necessarily a big surprise, is that the kind of assets the kind of assets that international investors are looking for in the multifamily space are larger, high quality assets, probably primarily in top markets. They're looking for trophy assets when they are buying stuff in the U.S. So that means bigger. So that would explain why the average deal size are bigger, why the overall price per unit is higher, and why the cap rate is lower.
Is it okay for us to go into the top international buyers? Like, who's doing this?
Yeah, so that was interesting. So in terms of the breakdown, what's interesting is of the 10 largest buyers from overseas or international, 5 of them are Canadian entities, and in fact, by far the largest buyer has been Brookfield. I think they've bought somewhere between $5 and $6 billion worth of multifamily assets this year, and that's like way larger than even number 2 on the list, which is also a Canadian entity called Tricon. They're somewhere between $1 and $2 billion, but then there's a few other Canadian entities, some Middle Eastern money, and as well as Capital Land from Singapore and PGGM from the Netherlands, also among the top 10 buyers. But people could see that top 10 list if they go to the website and read the full article.
All right. So the next topic that we're going to cover is industrial investors drive cap rates lower in secondary and tertiary markets. What do we have there?
So this piece is based on another recent piece of research, also from CBRE, who we quoted in the previous piece. In this piece, what I think the takeaway is that industrial investors are increasingly looking outside core markets, buying in secondary and tertiary markets in order to get in search of higher yields, but in the process of searching for higher yields, they're bidding the prices of these assets up higher. So you're seeing cap rate compression at a faster pace in some of the secondary markets than even you're seeing in the market more generally. So that includes places like Louisville, Kentucky, Orlando, Florida, Charlotte, North Carolina, Nashville, Tennessee, and Pittsburgh, among some other places. But basically that in those kind of places, the cap rate compression has been between 12 and 14 basis points compared to, I think, more like 5 basis points for when you look at just the overall all-in national cap rate for industrial properties, that includes everything.
And the director of Global Industrial Insights and Logistics with CBRE had an interesting quote. Would you like to share that?
Yeah, so that was Jack Fraker, who, like you said, is the vice chair and managing director of Global Industrial and Logistics with CBRE. He said, there's a lot of capital looking for higher returns. So a flood of capital is going into those markets. He notes that the drop in cap rates in Tier 2 and Tier 3 markets reflect escalating values due to increasing demand and rent growth and little new supply, which has generated strong competition for the few assets available for sale.
Now, some big news on the big box stores front. What do we have there?
So, yeah, this was interesting. It's hard to call this like a major trend yet based on the overall numbers, but it is something that is of interest. But, one of the big trends in the retail, it's been obviously it's no secret that retail has suffered. There's been a ton of store closures. There's a ton of empty big box space to deal with. One interesting thing that's begun to happen is that some self-storage developers are now taking some of this space that's at retail properties and using it to build self-storage assets instead. Since 2015, only, like, if you go back, looking back a little further, since 2015, only about 7% of self-storage properties historically had been converted from former retail buildings. That now rate has doubled, apparently, of the development of new self-storage properties. Something more like 15 or even up to 20% of them are conversions from former retail space. So I think, like, kind of unpacking that a little bit, what it means is that this has gone from being something that was happening just maybe on the margins to something that's not, still the bulk of self-storage development is ground up or conversion from warehouse space, but conversion of retail into self-storage is a growing piece of the pie.
What about the location aspect of this? I mean, a lot of these big box stores were in great locations, weren't they?
That's correct. Yeah. I mean, generally, retail is in a high traffic area. Self-storage hasn't necessarily isn't always dependent on that because it's a place that you need to go. So that's why often self-storage is off the highway, off of it's not in the middle of everything. But this is like, this is a new thing to sort of see self-storage in a more high profile, high traffic, more accessible location. So I think it's interesting, and that's exactly the kind of locations that retail would have been in.
Anything that we missed on the big box store that you want to talk about?
No, again, I would just direct people to the site. There's some charts and whatnot to go with it. So I think, it's more of like just this kind of interesting sub-trend that I think people could be aware of, and I think also could be useful, especially for people that may have empty big box retail space and are struggling to find a use for it. This may be a solution for them.
What other headlines or other things should people be checking out your site for?
Yeah, so it was a big, a lot of other stuff happened this week. We had a Viewpoint piece about multi-tenant retail offering net lease investors attractive opportunities. That's written by somebody from the industry, just kind of going over some of the more recent highlights there. We had a piece that went over what's going on with bridge lending, which is always an interesting subset of the financial market, and it's always good to check in with them, see how aggressive they're being, and how much of a deal they're willing to cover and what kind of rates they're offering. So we just had an update on what some of their activity has been like in recent months. An update on the overall CMBS delinquency rate, just the monthly reports came out for that. So we have just some bullet points and a charting with what's going on with delinquency rates by property type. And lastly, the National Apartment Association put out a report on income and expenses data for apartment buildings. So we did some takeaways from that as well, which again is kind of chart bullet points, but just a good something if people want to get some of their insights in a bite-sized form.
Well, David, thank you very much for walking us through all of these great stories that you guys have coming out.
All right, thank you. Thanks for your time.
If you have not subscribed to the podcast, make sure you click that subscribe now button below. That way, every time they come out with a new podcast, will show up directly on your listening device. And if you know somebody who really needs to hear this, well, it's super easy to share by clicking that share button below. So for everybody at NREI and for everybody at the Common Area Podcast, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of NREI or Informa. The content has been made available for information and educational purposes only.